welcome to yet another edition of Crystal Ball, with the market just a whisker away from an all-time high. I'm joined by Madhu Kela of Reliance Capital. Madhu, good to talk to you after a long time. I mean, things have moved a lot since we last spoke. Valuations have changed a lot. Are you as optimistic, or selectively in pockets have you started getting cautious on the valuation front?
Yeah, so I think in the beginning of the year, then I remember in the same show we spoke when the Nifty was around 7,000, and one had the guts to thumb the table and say that these are levels to buy, and one is willing to stake. Obviously, markets have moved 30%, 30-35% in the main indices from there, and there has been a lot of appreciation if you go a little deeper in the markets. So it's a no-brainer to say that obviously the comfort is not as high as it used to be when we were around 7,000 levels, because obviously valuations have moved up, But I just want to highlight here, Udyan, we should not, if you look at the valuation in the same metrics as which we are used to be looking for many years, and again I dare say it is different this time, because there is so much liquidity in the world and so much money is being pumped in by the central bankers. So basically equity is looking relatively better than fixed income, and as you are aware, like roughly $12-13 trillion of money is earning negative returns worldwide. Bonds, majority of the countries, we were looking at up to 7-8 years, majority of the countries' bond yields are virtually negative or zero. So, if the bond in Switzerland is trading a 50-year bond at a negative yield, so there is one certainty that if you keep the money in Switzerland bond for 50 years, you are going to lose money. So the only trick which people are playing, why are people still investing money in these bonds, is because of the capital appreciation. So I am saying, how negative can that yield go worldwide? Forget India. So our sense is that there is not much room for them to go further negative than here. So obviously a small shift from bond to equity can take, is what is keeping the equity valuation elevated. So that is the only justification of, it's not the only Indian valuations have moved up. Valuations worldwide across the world have moved up. So the only justification which I could come up is this shift from bond to equity, which is keeping the valuation elevated.
No, that's an excellent point, Madhu, and that is precisely what is driving this tectonic shift in money flows across the world. But just to scratch that point a bit deeper, do you see any risk to this hypothesis, which is driving global liquidity towards risk assets at this point in time, which can rock the boat? This is not an India-specific question. It's generally a question on whether the scenario that you just described, do you see that getting rattled for any chance in the foreseeable future?
Yeah, there may not be in a foreseeable future, but there are two things which we are monitoring very closely, which everyone who is monitoring this should monitor. One is that, does the world get into any deeper recession than where we are today? I think then it poses a different kind of risk to the world. And second, does the inflation come back in the world? Right now, as we examine, it doesn't look like an imminent risk. And let me dig a little deeper on the inflation point. The inflation actually may not come back in the world because of the demand issue. That demand is very vibrant, but it could also come back because a lot of supply is getting closed. Because if oil were to remain at $30, maybe 10, 15, 20% of the supply would have come under threat. So we have to monitor these things very closely, and we are doing it very extensively. But is there an imminent risk of either a big recession in the world or inflation going up? The imminent risk is not there. But can it happen at some point of time over the next 12-18 months? There is a possibility, and that I cannot predict today. Only thing which we can do is to monitor these things very closely. But the risk is there. One cannot rule out that world is always going to be this hanky-dory place wherein central banks will keep printing money, and that money will keep coming in equity market. Bonds will continue to trade in negative trajectory. Growth will not be there, but still you will be able to make a lot of money in equities. It looks very rosy, very good, but it cannot last forever.
So how much more can valuations expand, Madhu, out here and in other emerging markets? I mean, valuations go up in two scenarios. When where earnings are actually galloping, where we are not there, earnings are improving but they're not galloping right now. I mean, we've seen markets trading at 25, 27 P multiples also in good earnings scenarios, which we don't have right now completely today. The other is the scenario that you described, which is global cost of capital is so low that equity valuations are keeping on expanding. So now we are already at 18, 19 times or 19, 20 times, whatever number you choose to look at. How much more of an expansion in valuation can we justify at this stage?
Then I have learned in the markets in last 25 years that, highs are always higher than what we expect, lows are lower than what we expect. So it's very, very difficult to put a pinpoint that, at 20 times it will become very expensive, or 21 times it will become very expensive. Relative to the past, obviously it is elevated, but I think, if this scenario continues, I think there is another chance that it could melt up, because, one should not forget that even locally, see what is working specifically now, if you come down to India with them, that, in the world where there's even a 0.5% or 1% growth is so difficult to find in various pockets, we are still talking of 7.5–8% growth rate in India. We are still talking of select companies, good companies growing their earnings by 15 to 25% over the next 2 years. So this is a real golden spot in the world, and which is why a lot of money is coming. And to add to that liquidity point, what is happening locally with them is that, people who put money in real estate, people who put money in fixed deposit are really frustrated that, such a big bull market is going on in equity and we have missed it. Last 4 years, if I were a real estate holder, I am scratching my head every day that, what have I done? 60, 70, 80% of my portfolio is become illiquid. I cannot sell it. There is no appreciation. So you see, 1 lakh crore rupees have come in mutual fund over the last 12–15 months. And a lot more money could come if the real estate scenario, if the fixed income scenario remains where it is. So what I am trying to say that, in this market, it's very, very difficult to justify keeping historical trend that should I put a lot of money, can I thumb the table and say that Nifty is a great buy at 9,000 and the market is a great buy at 9,000. I don't have that guts. But will the market tank given where the global liquidity is, given where the locals are positioned? I can't even say that market is ready to tank because the valuations have got elevated.
Clearly the screen is suggesting that we are in a very bullish phase for the last many months. But there are pockets within the market which are not exhibiting that kind of momentum or interest. Cases in point are large sectors like IT, pharmaceuticals, now telecom. Do you sense any kind of disconnect that some of these maybe global facing sectors don't have the same kind of tailwinds behind them?
Yeah, they do not have, Udayan. See, market is clearly only respecting earnings. So wherever you have earning growth or a forecast of a big earning growth, markets are disproportionately rewarding, whether it are sectors or whether it is companies. But it's the sectors which you mentioned, whether it is IT or pharmaceutical or FMCG companies, consumer-facing FMCG companies, where there has been a earning downgrade, to say the least, over the last 12–18 months. Market is clearly not interested in these sectors right now, because even though they look optically, they look very comfortable in terms of valuation vis-a-vis the growth stocks or growth sectors. But market is just not willing to give that chance to these sectors as of now. In rotation, even though, I think the healthcare and the pharmaceutical sector, there could be select opportunities, as we were early on in this sector. But because this is a perpetual, this is a very long-term theme, and if stocks become selectively cheap out here, I think I would say that this is one sector which one should look at in all the downgrade sectors which are there.
Hold that thought, Madhu. I'll just take a quick break and be right back with you. We have many more sectors and earnings to talk about. Don't go away. We're back in a couple of minutes with Madhu Kela on this show.